Hello everyone. Today we are we are going to dive into the critical economic topics called debt sustainability management and understand how India manages its national debt using an IMF debt sustainability framework. It's called DSF. In a simple term, debt sustainability is refers to a country ability to meet its current and future debt obligation without falling into debt crisis. Right. And now let's deep dive into what is a debt sustainability, right? Debt sustainability ensure that the borrowing does not go on out of control, leaving the countries in a position where they cannot repay. That's a primary. And this framework particularly vital for emerging economy like India, which must balance economic growth and the debt management. And the IMF debt sustainability framework is a tool used globally to assess the risk of the country debt becoming unsustainable and offering countries like India to guide on the safe borrowing limit and warning the signals for economical instability. So this tool provides three things. One is the risk of country debt becoming unsustainable, and second is safe borrowing limit, and third one is warning signal for economic instability. Now, let's deep dive into what are the critical key components of debt sustainability. Debt sustainability framework focus on a three core area. One, debt to GDP ratio, which measure the total debt against the country economic output, which we are well aware. Debt serving capacity, the ability to meet interest payments and debt repayments. And third thing is the physical and microeconomical stability, ensuring that the government policies foster growth and can withstand economical shocks. That's primary. In a globalized economy, how country manages debt is crucial for investor confidence and economical growth. And the third thing is about the India's debt management. India's public debt management percentage of GDP is currently stands at 83.2%, slightly higher than the recommended safe threshold for emerging countries like India. But however, IMF and World Bank categorize the India as the market access countries. Normally, the IMF debt sustainability frameworks are two categories. One is LIC, low incoming countries. Another one is market access country. India falls under the market access country. This means India can access the international capital markets and borrowing at competitive rates, allowing to manage the debt more flexibly and compared to low income countries. And India debt to GDP ratio, historically, if you look at the India's debt to GDP ratio has fluctuated, it's kind of fluctuated. In F 2023, India's debt to GDP ratio was 83.2%, slightly higher than the desired, but manageable due to solid fiscal policy and sustainable economic growth. According to IMF debt sustainability analysis, which is called as a DSA for MAC countries like India, debt to GDP ratio is under 70% is considerably safe. But India's current positions not alarming, even though it is 83.2% due to steady growth projections as well as prudent debt servicing strategy. Now, how India uses the DSF. That's the primary question we are going to answer now. Now, how India uses the debt sustainability framework in a practical. India applies the DSA to forecast debt trends based on future growth, fiscal policy, and global economic conditions. But the Reserve Bank of India and the finance ministry regularly monitor key parameters. There are three parameters. One is an interest rate on external borrowing and inflation trends and GDP growth projections. These analyses help to ensure that debt servicing does not consume too much of the national budget. That means that economy can grow without being weighted down on the unsustainable debt. This is very, very primary. So it helps to monitor three things: interest rate on external borrowing, inflation trends, GDP growth projections. This is how India uses the DSA. Now, Now let's look ahead, right? Despite of these challenges, India diversified economy and robust institution and consistent physical monitoring put into strong positions, right, for the future aspect. India has demonstrated resilient during the global shocks such as the 2008 financial crisis and COVID-19 pandemic situations by adopting the debt management strategy in a real term. In conclusion, debt sustainability management is a balancing act, especially for growing economy like India. The IMF debt sustainability frameworks provides a vital toolkit for understanding, assessing, and managing a debt efficiently. By focusing on maintaining a strong physical policies and ensuring sustainable economic growth, and India continue to manage its debt responsibly while fostering long-term developments. And thank you for watching. I hope this gave a very clear understanding of how India approaches debt sustainability. Thank you again. Have a wonderful day.